Hi, good afternoon, everyone. Sure, quite a few of you know me, but my name is Hamid Ghafoor. I am the National Lead for Social Housing at BDO. So in terms of today, what we're going to talk about today is the amendments to FRS 102 and the impact on social housing. And with me today to talk through those amendments will be Paddy Jenner, who is a director in my team, and Andy Holt, who is a senior manager in our technical team. So in terms of the presentation itself, see the agenda on the screen at the moment. So it's very much focusing around the housing SORP, the effect of FRS 102 on the housing potential housing SORP, which is going to come out later on in the year. We'll talk a little bit more about some of the practicalities around that, which Paddy will focus in on, and then on more technical bits, Andy will focus on those in terms of where we see the key impact of this. And I think what will come out from this for yourselves is that this is something that you really need to be thinking about now. There is an opportunity for you to send questions in. So there is a question and chat function that you'll see on your screen. And so if you've got any questions, please use that function, and we'll be able to answer those questions at the end. There'll be some time at the end to either ask more questions, or we'll answer direct questions coming out from that chat function. But without further ado, I'm now going to pass you across to Paddy, who will talk through the timetable. We're all in one room, so the way this will work is that I'll actually move across and he'll come across. So I'll disappear for a second and he'll come in. But I'll pass you across to Paddy Jenner. Thank you.
Okay, so thank you, Hamid, and good afternoon now, everyone. So to begin with, we're just going to talk briefly about timetables, the new FRS, and then how that will be impacted by the SORP. So you'll see on the screen there, this is most likely the biggest change in accounting standards since the adoption of FRS over 10 years ago now. And at the adoption of FRS, there was put in place a provision for a five-yearly review of the standard itself and potential for revision. And as of March 2024, we reached the end of the second review of FRS 102. And as of March 2024, there was a revised FRS issued. That FRS will be effective for periods beginning on or after the 1st of January 2026. And so alongside that, we'll see that for all social landlords, that first period ending after that will be from March 2027, with, as you'll see on the screen, the potential for early adoption permitted, assuming that you take all of the amendments. However, we'd be surprised to see much of that within the sector on the basis that the sector tends to have a large degree of similarity across processes and ensuring that everything is consistent and comparable. The one thing I would say about this is that although March 2027 feels like a long way away at this point in time, when you work back and recognise the fact that your comparables will also need to be amended, and that the opening balances for those comparables will be as of 1 April 2025. We are, as of Tuesday, already within that period. And so you'll see that the challenges potentially around timetable already start to manifest themselves. So then moving to the housing SORP itself, we expect revised SORP to be published in late 2025. The application dates for that will then coincide with the FRS 102, meaning that they'll be effective for periods beginning on or after 1st of January 2026. And immediately there you begin to see the tightness of this timetable in the sense of when the SORP will be published and when the application date of that will be. However, it is important to say that the SORP will not apply or create new specific accounting rules. It is there as a way of clarifying and interpreting what that new FRS says. And as part of that, given that we now have the FRS in place, we can begin to interpret and clarify what we expect to be the key areas. And that is what Andy will focus on later in this session. So if we then just move on to the timetable for the Housing SORP itself, you'll see on screen there in March 24, as we said, FRS 102 revised was set out. And then between March of 24 and today, the SORP Working Party have been drafting the new Housing SORP to comply with that FRS 102 revised and wider SORP reviews. From now through to May, we're expecting the FRC to approve that draft SORP ready for the consultation. There will then be a 12-week consultation period over the summer this year, for which ourselves and other key people within the sector will go back on that consultation with responses, and then into October and November of this year, we'll then see a review of that consultation response and potentially updated SORP requirements, with a view that the FRC will then look to approve that final SORP as of November 25, with a potential early Christmas present in December 2025 of that published SORP, with the effective date of 1 January 2026. And again, as you see there, there is very little scope for slippage within that, and we do butt up quite close to that deadline of the effective date of January 2026. So then just moving to the new FRS 102, and as I said earlier on, although that 31 March date of 2027 appears a long way in the future in terms of applying the new FRS and the Housing SORP, it will come round much quicker than we expect, especially when you consider that your comparatives will be at 31 March 26 for your balance sheet and P&L, and obviously the opening balances for those March 26 figures will be as of 1 April 2025, being Tuesday of this week. So therefore, this is a big challenge for the sector, a big challenge for the accounting industry in general. And in particular, some of those challenges, as you see there on screen, initially, we start with the timetable. The publishing of that SORP within winter of 2025 with the effective date of 1 January 26 is tight and will lead to uncertainty as we move towards the end of the year, and we have to do what we can to avoid that uncertainty. And one of those things is to be here today and listening to what we expect to be the larger impacts of that. Some of those larger impacts are certainly going to revolve around records and support for those records, especially when you get into the more time-consuming and complex areas of lease commitments and potential issues around contract revenue and the terms and conditions that will be applied. In particular, then, I think lease accounting and the costs incurred around lease accounting will increase due to the complexity of that reporting and what we see within the IFRS world when it comes to IFRS 16. And also, when you look at the familiarity or lack of familiarity that you'll see within the sector towards IFRS and the impact of when 15 and 16 were applied in the IFRS world, the importance of thinking ahead on these, taking advice where necessary in terms of professional advice, but as much as anything, listening and communicating with peers to ensure that you're on top of where you want to be and you understand what the conclusions are you want to get to. And with that in mind, I'm now going to pass over to Andy, who's going to get us into the detail of where we see those amendments to be. Thank you.
Thanks, Paddy. Okay, so this slide provides a high-level summary of the main changes as a result of the revised FRS 102, which is the accounting standard almost all social landlords apply. The main areas impacting are the left and middle items, which both reflect similar changes to international accounting standards that have happened in the last 10 years. On the left, Section 23 revenue has been rewritten wholesale, effectively, with significant changes as a result. This has brought in a 5-step model based on IFRS 15, as Paddy's alluded to, for revenue recognition, which may impact the timing of revenue recognition for organisations with contracts for services or other contractual income streams. There are other revenue considerations that we think could impact the sector, specifically in relation to service charge income accounting, but we'll touch on that slightly later. As per the middle circle, Section 20 leases, also a substantial rewrite. It's significantly longer now. This change will bring on-balance sheet lease accounting modelled on IFRS 16, which will impact landlords that hold operating leases as lessees. The distinction between finance lease and operating leases, as we have under current UK GAAP for lessees, will disappear. There won't be that concept anymore, although finance lease, operating lease will still exist for lessors. There are, as per the right-hand circle, various other incremental improvements, but given the relative significance of those, I'll only touch briefly on those today. With these significant changes to revenue and lease accounting, one thing that's really important, I'll repeat this several times, lessor accounting isn't changing to any great extent. So rental income, the main income stream of the sector, shouldn't change in terms of measurement and timing of that income. So that should be unaffected. Okay, before we get into the technical details, I think it's important to have a picture in your mind as to what the changes will actually look like. Paddy's already talked about the transition dates and mentioned that early application is permitted, but probably unlikely for most in the sector. For leases, the transition approach to that is retrospective, but with the cumulative effect of applying the amendments as an adjustment to equity at the date of initial application. So that's known as modified retrospective or cumulative effect approach. So under that, there's no restatement of the comparative balances and transactions. I will go through that in a bit more detail. With leases, there is no option at all to restate those comparatives. So just bear that in mind, because that's important as we go on to future slides. Revenue side of things, there's a choice to be made, either fully retrospective, restating comparative balances and transactions, or to follow the cumulative effect method as for leases, where you don't restate your comparatives. That takes a little bit of getting your head round, so I will just demonstrate that visually on screen. So you can see on the left-hand side for fully retrospective, where we restate the comparatives, the opening balances. On the left-hand side, your income statement and balance sheet. You will have seen a prior restatement, I'm sure, in the past. You can see restated above the 2026 numbers. They've been changed for the new FRS 102. And the statement of changes in equity, we're changing our comparative, restating our comparative opening balance. So 1st of April 2025. You'd need to include disclosures in the fully retrospective restatement method to show what the impact of those changes on your prior period balances. So the modified retrospective or cumulative effect restatement, this is the one you might not have seen quite as much. So as I've said previously, lessees must apply the cumulative effect approach. So there's no restatement of comparative information at all. You recognise the full impact to the opening balances to retained earnings on the first date of application. So for the sector, 1st of April 2026, and there's no requirement to disclose the impact on prior periods. So again, looking at that, so you can see what it actually looks like. On the left-hand side, you can see that your 2026 numbers would be as per old UK GAAP, and your 2027 numbers as per new UK GAAP. Does create a bit of an issue in terms of telling the story of your financial statements. You've got two sets of figures which are based on different accounting bases. So you need to make sure you're telling that story. Might be something to think about with your value for money. Self-assessment might impact on those numbers. You can see on the right-hand side, the statement of changes in equity, or statement of changes in reserves, as it's commonly known in the sector. That comparative section isn't changed at all. That's your old UK GAAP numbers, and the restatement is presented as at 1st of April 2026. So your first day of adopting FRS 102 revised. The disclosures that you have to include for the for FRS 102 updated are the impact on the current year compared to what the numbers would have been under old UK GAAP. So that's quite an interesting one. Lots to think about there in terms of, obviously, lessees have to use the cumulative effect method shown on this screen. For the changes to revenue accounting and contract accounting, there's a choice there. So you might end up with a whole mixture of different approaches across the sector. I know a lot of IFRS 15 adopters went for the full restatement approach because they didn't sort of like the concept that revenue might be recognised in reserves that's never appeared in the statement of comprehensive income. But there are a number of factors to think about there. Moving on to revenue accounting. So Section 23 of FRS 102 introduces a single comprehensive 5-step model for revenue recognition for all contracts with customers. This is based on identifying the distinct goods or services promised to the customer and the amount of consideration to which the organisation will be entitled in exchange. The core principle is that revenue should be recognised to depict the transfer of control of the promised goods or services to customers, which are the performance obligations under the contract. The requirements are significantly more prescriptive and precise than the existing version of FRS 102, which bases revenue recognition on the transfer of risks and rewards. It's that prescriptive and precise wording that sort of brings service charge accounting into question in terms of how exactly we do that, and we'll cover that on later slides. So while risks and rewards are considerations in assessing whether performance obligations have been met, they're only one of a number of factors that you now need to consider under the updated FRS. This is going to mean changes to the timing and profile of revenue for many organisations. For example, there might be a change from point-in-time revenue recognition to overtime recognition, or vice versa, or a combination of both of those as you account for the separate elements of a contract. The 5 steps that are within the revised FRS 102 are listed on the slide. So you can see step 1, this is where we identify the contract. A contract usually creates enforceable rights between a vendor and the customer. At step 2, we identify the promises or the performance obligations within a contract. These are to transfer either goods or services that are distinct from one another. Separate promises must be able to be delivered to the customer and the customer benefit from them in isolation. Step 3, determine the transaction price for the entire contract that we've identified in step 1. Step 4, we allocate the transaction price to each performance obligation identified in step 2. There's a judgment and estimate required there, and we'll do an example of that on the next slide. And step 5, we recognise that income when the performance obligations are satisfied. Just to say here that the purpose of this session isn't to do a deep dive into all 5 of those steps, as we don't have time, but there will be a link within the final slide to BDO's financial reporting webinar programme, where you can access step-by-step considerations of each of the revised revenue model steps, and the same for lease accounting in terms of a much deeper dive than we're able to do today. At this stage, I think it'd be helpful to look at a simplified example to illustrate the 5-step revenue model. So in this example, an RP has an annual boiler service and repair contract with an individual homeowner with a total contract price of £100. The contract includes an annual boiler service, which is expected to occur in December. There are unlimited repair call-outs, and based on past experience, there's an expectation of 2 call-outs on average per year. So probably not a very high quality boiler that's been installed in this particular home. Finally, a boiler usage remote tracking service, which is provided throughout the year. So under existing FRS 102, the entity recognises the £100 contract price on a straight line basis over the 12-month period of the contract. Following the amended standard, the entity identifies the performance obligations that are separable and where the customer can benefit in isolation, which are the repair call-outs, the annual boiler service, and the usage tracking. So all of those are services which could effectively be sold separately. The transaction price from individual purchases, if they were sold separately, is set out in steps 2 and 3. In step 2, this is the standalone price that we would charge for each item. The price of the repair call-out is £50 per call-out. I would expect 2 call-outs per year, so £100 is shown in step 3 column. However, revenue is capped at £100. So obviously we can't charge the full 150, which we would have charged individually. So how might the transaction price be allocated to each of the performance obligations identified in step 2, and when would the revenue be recognised? So as we move on to the next slide, in this case, the entity may use the standalone purchase price of the respective elements as a proxy for allocating the £100 to each of the performance obligations. So the £30 price for the annual service represents 20% of the total fee, 20% of the 150, that is, if the customer paid for a one-off boiler service. So therefore, the entity can allocate 20% of the £100, so £20 to the boiler service, and the remainder of going to the repair and usage tracking elements. So for simplicity, we've assumed here that the repair and usage tracking elements are spread evenly across the year in terms of revenue recognition. But if this is a cyclical or has a particular pattern to it, so for example, breakdowns occur mainly in winter months, that would also be considered in the timing of the recognition of the income. So a straight line recognition over the year might not, in this example, be the most appropriate approach. You can see that can get quite complex making these assessments and judgments. The annual boiler service of £20 income is recognised at a point in time when the service is performed. So that would be in December in this example. This is a very simple example just for illustrative purposes, but you can see here that there are assumptions and complexity associated with determining the timing of the income recognition. For example, if we assumed that there was only 1 repair call-out per year, then the allocation of revenue to the annual boiler service would increase. And assumptions like that can have a really big impact on the pattern and timing of your revenue recognition. So if we look at the main income streams for the sector and which of those are likely to be impacted, we've already talked about rental income. We don't think there's going to be a big impact on that because lessor accounting doesn't change. There are likely to be some further or different disclosure requirements, which we will find out about more in due course as we get the SORP and potentially an updated accounting direction. Service charge income, the accounting principles haven't changed here significantly, but the more prescriptive wording of section 23 of FRS 102 may mean changes in practice, which I'll come to on the next slide. Property sales, no change. That remains recognition on completion of the transaction. Grant amortization, again, no change. The accruals model will see that amortized over the life of the underlying asset. And contractual income, which to a greater or lesser degree impact on most housing association groups, given the diverse nature of operations. That's the area where even if the changes aren't that significant, there's a significant amount of work required and fact-finding to form your evidence base, to conclude on treatment, and then to process those transactions and changes through the accounts. So, as I mentioned, let's have a look in more detail at service charge income. So the existing SORP is already clear that service charge income should follow the revenue rules of FRS 102 rather than the lease rules, which dictates how rent is accounted for. Service charge income must be recognised when expenditure is incurred. However, if we look at what's typically done in practice, what we see across the sector, so we have for variable service charges, tenants or leaseholders only pay for the actual costs incurred. That will include obviously any management costs, which includes any margin that the housing association is making. If in any year the budget exceeds actual costs, the tenants are refunded, and vice versa. There's an extra charge if they haven't been charged enough, usually by a change in the future service charge amount that's set. Because of the timing of the service charge setting cycle, it's often 2 years before that catch-up of under or overcharging is corrected. Some social landlords adjust for the under or overcharge of income once they've been able to calculate it. So that might be in the following financial year that the costs and income was actually recognised. And some wait for the cycle just to correct itself over the, as I said, probably 2-year cycle with changes to future service charge income amounts. In either of those cases, the income recognised in any given financial year on an individual variable service charge scheme is likely to be misstated. It's this timing difference that the more prescriptive wording of section 23 of revised FRS 102 may well impact. So as we move on to the next slide, just a caveat, we don't know what the revised SORP will say on service charges yet, but as we've already mentioned, the SORP can only interpret what FRS 102 sets out. So some of the elements of FRS 102 section 23 that are applicable to service charges are set out on this slide. I think the key one is the bottom bullet, which requires that changes to estimates in transaction price are to be recognised in revenue in the period in which the estimate of the transaction price changes. This implies that an in-year adjustment is required to adjust revenue for the under or over provision of service charge of the estimation of service charge costs and therefore income. So what impact will this have for RP finance teams? Well, as you'd expect, that depends on what you currently do. You may already make in-year adjustments for variable service charge costs versus budget differences, in which case you potentially have no change to what you're doing. Even when that is the case, finance teams need to understand and document the different performance obligations within service charge arrangements. Is it appropriate that they can be grouped together and recognised over time, which is probably the expectation of what most typical service charge arrangements will do moving forward and already do? Or are there non-standard items within those service charge agreements that an over time recognition approach wouldn't be appropriate for? I go back to boiler servicing as a potential example of that we showed in the previous couple of slides. In relation to the in-year revenue adjustment for under or overcharging, this is going to require earlier specific scheme cost allocation and reconciliations. This will put strain on finance teams in an already really busy period. Potentially, it will require more detailed scheme level cost monitoring during the year, as well as at reporting dates. Some service charge reporting dates aren't coterminous with 31st of March, so these would need consideration as at 31st of March, as well as actual scheme reporting dates. You may potentially be able to argue that any adjustment for variances on service charge costs will be immaterial, but that in itself is going to require an appropriate materiality assessment and an appropriate bank of evidence to support that assessment. Finally, the work outlined above will need to be appropriately evidenced and documented to allow appropriate review, both internally and by auditors. So if you've done that assessment but haven't evidenced it, you haven't got anything to prove that what you argue to be appropriate is the correct way of going about things. So make sure you're capturing and properly documenting this thought process as you work, as you go along. Now let's consider the proposed amendments relating to leases. As noted previously, on balance sheet lease accounting would be brought in for FRS 102 with some optional simplifications as compared to IFRS 16. This will mean significant changes in accounting and reporting requirements for lessees. I've already stressed, and I'll do so again for the third or fourth time, that there are minimal changes for lessors. Examples of the types of items that have previously been treated as operating leases in the sector that will be impacted by these changes are office property leases, vehicle fleet leases, and large plant and equipment leases. Currently, those items have been classified as operating leases, and lease payments have hit operating expenses as rental costs. Moving forward, leases for such items will be on balance sheet, and the cost ultimately impacting different areas of the income statement, which I'll go on to in later slides. As noted previously, there's no option other than to apply the modified retrospective or cumulative effect approach in restating, and this will all be shown on the first day of your new GAAP reporting period, so 1st of April 2026. Just to note on leases, I'm specifically not going to cover a couple of areas today, which I'm sure some of you are quite pleased about, which is the consideration of the definition of leases, assessment of separate lease components and non-lease components within a lease agreement, or the determination of the lease term. All of these are covered in the BDO financial reporting webinar series, and we will provide a link to that when we circulate the slides. Before we go into some of the requirements, let's pick up two exemptions. These are hopefully going to be quite useful in taking quite a few items off the to-do list in terms of the work program that you've got. So for lessees, section 20 contains two optional exemptions from the general requirements to recognise a right of use asset and a lease liability. These are short-term leases and leases for which the underlying asset is of low value. For short-term leases, that's defined as leases that at the commencement date have a lease term of less than 12 months. So your short-term items you will continue to account for as you have done previously. A lease that contains a purchase option is not a short-term lease, and the options to extend or terminate the lease need to be considered as part of the short-term test where they're reasonably certain to be exercised. That's a key judgment there in terms of it being reasonably certain or not. The short-term lease exemption needs to be applied consistently to all underlying assets in the same class. So as an example, you could apply the exemption to all short-term vehicle leases, but not for short-term property leases. But you couldn't do one short-term property lease as in old money an operating lease and another one as a right of use asset. You have to be consistent across class of asset. For the low value lease exemption, whether an asset is of low value is determined based on the nature of the underlying asset. Items like land and buildings and vehicles are specifically not considered to be low value items, and they're included in the list of items that can't be classified as such, along with things like trains, planes, etc. Big chunky bits of kit are specifically not low value assets. Whether a lease is low value is judged by reference to not judged by reference to materiality. So a leased asset considered to be low value would be low value for a big or small organization. It's not to do with how big your organization balance sheet is. Further to that, the exemption is applied to each individual asset. So consequently, an entity that enters into leases for 100 low value assets, is not required to aggregate those and consider the effect in total. So it could therefore keep all 100 of those low value leases off balance sheet if it chooses to do so. And there's no actual examples of low value leases included in revised FRS 102, but we have got some guidance as to what that might be. There's various IFRS decisions out there. They suggest items such as tablets, personal computers, small items of office furniture, telephones. The original 2015 IFRS judgment concluded that a value of $5,000 was the number they had in mind. We do understand that for FRS 102, the FRC intended low value items to have kind of a higher threshold than that, so it might be higher than that $5,000. One further thing to bear in mind is that you're not looking at the value of the item at the point you buy it. It's the value it would have been when it was new. So if it's a used car is a bad example because it's specifically excluded, but a used item of plant that is now not worth very much might still not be allowed to be a low value asset, a low value lease, because its value when it's new would not have been low. So if we look at the lease accounting and what to include in the initial balances for our lease liability and right of use asset. So, as we've already outlined, lessees need to recognize lease liability on their balance sheet that reflects the promise to make future rental payments under the lease contract. At the same time, a corresponding right of use asset is recognized. You need to start with the amount for the lease liability. It's really important you do it that way around. So at the commencement date, lessee needs to measure the lease liability at the present value of the lease payments that are not paid at that date. Lease payments are discounted, and I will cover that on the next slide. And there are various other elements that feed into the calculation, as we've shown in the slide, such as the exercise price of a purchase option, where that's reasonably certain to happen. For the right of use asset, we initially recognize the right of use asset at cost. Cost comprises the amount of the initial measurement of the lease liability. If there's a non-exchange element in there, because lease payments are significantly below market rate, the income is accounted for as a contribution to the cost of the right of use asset. You then need to adjust for any lease payments made at or before the commencement date, and you need to deduct any lease incentives received. You would add back further to that any direct costs incurred or provision for any restoration of the asset at the end of the lease term, any dismantling or anything of that nature. The future lease payments included in the lease liability need to be discounted using the interest rate implicit in the lease, if that rate can be readily determined. If you can't determine the rate from the lease agreement, the lessee needs to choose on a lease by lease basis to apply either their incremental borrowing rate or the obtainable borrowing rate. There is an exemption for public benefit entities to use the rate on deposits held with financial institutions. Whilst housing associations are public benefit entities generally, that isn't expected to be applied. I can't see it. It's kind of a last resort that I wouldn't expect a housing association not to be able to identify its incremental borrowing rate or obtainable borrowing rate. So the incremental borrowing rate is the rate they'd have to pay to borrow over a similar term with similar security, the funds necessary to obtain an asset of similar value. The obtainable borrowing rate of the lessee is the interest rate they would have to pay to borrow over a similar term, an amount similar to the total undiscounted value of the lease payments. So just in terms of definitions, they're slightly different items, but from my past experience in the sector, both of those are obtainable by landlords. Moving on to subsequent measurement of the leases. So After the commencement date, a lessee measures the right of use asset by applying the cost model or the revaluation model for property, plant and equipment. If the right of use asset is investment property, you account for that as if it is investment property under section 16 of FRS 102, as you would for any other investment properties. So you're holding that at fair value. In the sector, I only really see cost accounting for property, plant and equipment. So for costs under the cost model, the right of use asset is measured at cost less accumulated depreciation, impairment losses, and adjusted for any lease modifications. The lease liability, similar to a finance lease liability, after the commencement date, a lessee remeasures the lease liability by increasing the carrying amount to reflect interest. So debit interest expense, credit lease liability, reducing the carrying amount to reflect any lease payments made, and remeasuring the carrying amount to reflect any reassessment or lease modifications that have occurred in the period. There are various practical expedients available to lessees. One of those that might be quite useful is if at transition date your lease has got less than 12 months to run from the date of initial application, you can choose to treat that as a short-term lease and carry on accounting for it as you always have done. And you can also use hindsight in determining things like lease terms. So if the contract contains an option to extend or terminate, you don't have to put yourself into the position at transition date. Will we extend, will we not? You can actually look at whether you did extend or didn't extend, which is obviously quite a common sense one. This is the last slide on leases. I'm sure you'll be pleased to hear. So how will leases be presented in the financial statements? In the balance sheet, as I've already mentioned, we've got a right of use asset and a lease liability, which will be recognised in their respective sections of the balance sheet. The right of use asset is either included in the balance sheet on its own line or within property, plant and equipment with separate disclosure for right of use assets within the note to the accounts. As we've already mentioned, operating leases are not currently included on the balance sheet, and nor are the underlying assets. So that is a chunky change if you have an awful lot of these or high value operating leases that you accounted for previously. In the income statement, the interest expense on the lease liability is included within other finance costs. Depreciation of right of use assets is recognised within operating costs. Operating lease expenses within operating costs would only be recognised for short-term and low-value leases that we talked about before. In the statement of cash flows, currently, your operating lease costs will be reflected as operating cash flows. In the revised model, the principal element of lease payments, it will be included in financing activities. So that's a change in how that cash flow will be presented. The presentation of interest depends on the accounting policy, so either finance or operating cash flow. I typically see that as a financing cash flow, but there is an accounting policy choice there. Lease payments for lessees that are not recognised on the balance sheet will continue to be operating cash flows, so that's your short-term and low-value leases. Paddy will briefly touch on this later, but these changes, especially to the income statement classification of costs will impact on your loan covenant calculation, so your interest cover calculation in particular, and you need to be thinking about that and holding discussions with lenders on an appropriate timescale. I think we are just about okay for time, so I'll briefly touch on some of the other incremental changes. So this slide shows some of the changes that were flagged specifically by the FRC. In terms of impact on the sector, I don't think either of the first two are going to have a major impact and are about creating greater alignment with international accounting standards. Our publication, which I'm sure you've all got, on the differences between new and existing UK GAAP, that's really useful in looking at those changes in definitions, things like a new definition of assets and new definition of liabilities that might impact on your accounting policies. Number 3, there are new disclosure requirements about supplier financing arrangements. That's an interesting one because that applies for year ends from 1st of January 2025. So for the sector, 31st March 2026 year ends, that applies to. That said, I'm not currently aware of any such supplier financing arrangements. That was around a load of quite a few high profile business failures where such financing arrangements were in place but weren't readily apparent from reading the financial statements. I wouldn't expect the 4th item to have any great impact on the sector, but if you apply IS 39 to financial instruments, you can continue to do so. And step 5 around small companies, I will touch on the next slide. So small entities continue to be exempt from many of the disclosures under FRS 102. However, the review of FRS 102 has increased the number of disclosures that need to be made subject to materiality. These additional disclosures relate to a statement of compliance with FRS 102, going concern, dividends, leases, provisions and contingencies, share-based payments, revenue, related parties, and deferred tax. Small entities might need to obtain data, therefore, that is not currently readily available, and in order to meet these disclosure requirements, and therefore this is something they need to be thinking about ahead of transition year. RPs need to be thinking about this for any subsidiaries preparing accounts under small companies section 1A of FRS 102. For Companies Act subsidiaries, although not an FRS 102 change, so we're not covering it in detail today, but it's worth being mindful of the forthcoming increases in company size limits and a reduction in the requirements for directors' reports for large and medium-sized companies. Those changes are effective 6th of April 2025. In terms of some other amendments that may impact on the sector, but are generally more guidance than anything else. Intangible assets, Section 18 now provides clarification on the classification of assets with both tangible and intangible elements. Related party disclosures, there's a requirement to disclose the amount of any commitments to related parties or any related party commitments. In terms of employee benefits, there's guidance relating to estimates and assumptions used to remeasure defined benefit plans. Borrowing costs, there's an update that excludes specific borrowings from the capitalization rate for general borrowing, so exclude that from the calculation, those specific borrowing rates. And in terms of specialized activities, particularly impacting on charities, if you have those within the group, there's guidance around heritage assets and non-exchange transactions for public benefit entities. I'll now hand back to Paddy to look at some of the practical considerations and key messages.
Right. Well, thank you very much to Andy for that. I'm sure everyone's head is spinning a little after all of the technical detail there. And for a couple of minutes now, we're just going to think about what the practical implications of this may be. Ultimately, you'll see here on screen a number of potential implications, and then in the black, some of the potential resources that are required. The key from our perspective here is that there is going to be a significant amount of change. It's coming and nobody can change that. And where we've been involved in similar exercises in the past, and when IFRS went down the route of 15 and 16, the most effective organisations and the organisations that fare best in these situations are to accept that the change is coming and use all of the support and advice that is out there, both in terms of us and other firms and also the peer group within which you sit, to ensure that you get to the conclusions that you need to in the right time. I think just picking up a few things on the screen there. So review of current lease arrangements, it's going to be imperative, as you'll see from Andy's discussion earlier on, that you have a really detailed understanding of all lease arrangements, that you have a complete population and you're comfortable that you have all of those leases to hand. and that you have all documentation around leases, not least because that will help to take some of the simplifications where you may potentially have short-term or low-value leases to ensure that you can take those simplifications. On the side of income in particular, it's going to be imperative that you do full review of revenue streams, in particular focusing on those contract income streams and pulling out the 5 stages of the revenue recognition, and ensuring that you have all details in order to record those areas. And what we did see when we went through IFRS 15 is that often you need to get outside of your finance team with some of these contract revenues to understand all of the points within them, to do a full and clear analysis of what those requirements are and how they can impact from a revenue recognition perspective. And that will lead you to having a complete contract list that you can then help to provide to the auditors, and we can review thoroughly early in the process. As Andy mentioned, also, beyond the practicalities of this, there will be impacts on the P&L and balance sheet and the classification of certain items, and that could impact on covenant compliance. So it's really important that you begin to understand what those potential issues could be early and have those discussions with your borrowers now and in the months ahead to ensure that they're on board and they understand what it is that you're going to need to do and when you'll do it. And as I've said there's a number of resources that we've set out there in terms of the FRC, professional advice from both ourselves and other firms, and then also the peer group within which you sit and what you take from each other. So just moving on to this final slide, in terms of help and guidance, we've set out there the link to the document that we've sent round a number of organisations with the changes that we expect for FRS 102 in the sector. There's also a link to the BDO financial reporting webinar series, and then those FRC fact sheets that give you further information about the expected changes. So at that point, I know there's been a lot of information, so I'm just going to pass back to Hamid, who is going to give us a final sort of key messages and thoughts ahead of any questions.
Thank you, Paddy. There's a lot to think about, I think, for finance teams within the sector. And it's quite interesting when we're talking about the timetable, that actually within the time frame now in terms of the comparatives and the impact on comparatives, and even where you have situations where you don't believe there's going to be a significant impact, there's quite a lot of work that will need to be done to prove that you haven't got that significant impact. So you have to go through quite a process. So, I mean, in terms of what I've taken away from today, I think obviously some real changes that could impact on the sector, particularly around leases, the revenue piece. I think the service charge piece is challenging. From my experience of working with organisational service charges, organisations always find service charge accounting challenging in any case, and now we've got this additional change, because that is clearly an area also that tenants can do challenge as well. So it's clearly an area that organisations got added complication, and organisations will need to get that right. But I think the most important takeaway for today is that really, as organisations in the sector, you need to start thinking about these changes now and how you're going to apply those and how you plan for that, really. And that's around within finance, but also some of these changes will impact on wider in terms of wider than just finance teams, and also do people within senior management positions and governance, are they aware of this happening? Because this is going to put a lot of stress and strain in terms of resources on organisations in the sector when you're already under a lot of stress and strain because of the environment that you're working in. So what we're going to do is we're going to I think I've had some questions through. Yes, we have. So I'm going to in a minute pass over to Andy, who will sort of handle some probably the easier questions or the more difficult ones. But what we will do is we'll obviously, everyone on the call today, we will send the slides down around. There will be a follow-up in terms of that. And also this what I should have said at the start was this will be we're doing a series of these. So as this evolves in terms of our understanding of how this is going to impact on the sector, there will be other publications and webinars also that we will issue to ensure that you're right on top of what's happening. But I will now pass you across to Andy, who will just talk through a couple of the questions that come through.
Thanks, Hamid. That's the first he's told me about having to do more webinars. So thanks for that. So yeah, we've got quite a few questions through, some of which I can answer, some of which I can't for various reasons, but I'll touch on those. So do we expect the SORP to give any exemptions for the sector? No. The SORP can only interpret what's already there. So the SORP Working Party are discussing with FRC different bits and interpretations they want to apply, but they can't provide exemptions to the requirements of FRS 102. So on leases, how and when does the lessee recognise if they renew the contract with another period, so 12 months, for example, which was not an option on the original contract? So that's accounted for as a lease modification. And to be honest, it would depend on the specific terms of the modification. So it could be accounted for as a separate lease or by adjusting the existing right of use asset and lease liability. When will you be auditing the restatements? That maybe one for Paddy and Hamid more than me nowadays, but that will depend on a case-by-case basis when you've got the information ready. But it would be a good idea to get that information ready well in advance of the in terms of your restatement, opening restated balances well in advance of the main audit for March 2027. Will RPs do fully retrospective restatement or cumulative effect restatement? That remains to be seen. There might be some guidance or general principles adopted by the sector. Bearing in mind, you have to do the cumulative effect restatement for leases. There's no option there. You don't restate your comparative for leases. So I don't know. Maybe it's easier to do every revenue changes in the same way using the cumulative effects approach. If we look at some more, presumably internal management accounts can still be done as they currently are, and revenue recognition methodology would only be applied for year end if a contract straddles 2 years. I think that's an internal management decision. I think what's proposed there of reporting on the current basis where you have that that crossover of contracts between 2 years would be sensible. That said, you'd want to understand what the impact would be, and then obviously the accounts that you file under FRS 102 would need to reflect the appropriate accounting. Got a couple of questions specifically on things that are expected in the new SORP. Whilst I have some knowledge of what might be in the SORP, I don't think it'd be appropriate to talk about that until it's been released for consultation. I think we are just about on time now. I'll just take one more question that I've spotted. You mentioned impact on loan covenants. Can you explain further? That would be where values of assets, values of liabilities are changing your potential. So that side, you're going to be changing your indebtedness. You're going to be changing your asset base. So that would impact on gearing. I wouldn't expect that to be a big change, but currently interest cover for most of the sector is operating surplus as adjusted for various items, divided by interest, often not in net interest. The lease changes in particular, if you are bringing a lot of leases on balance sheet, you will then be depreciating those leases, and that's the cost that hits operating surplus. Depreciation in most loan covenant calculations is an add back, so that cost no longer hits operating surplus. And you're now getting an interest charge, which is an increase on the bottom half of your calculation there. So that's probably the main area of impact. I'm conscious you probably want to get some lunch, and I certainly do. So there are some more questions, and we will provide answers to all of those in due course. But thank you for being with us today. And we, as Hamid said, we will see you again soon.